Rohr here with another concise highlight early on Thursday, June 12th, 2014. It's currently about 6:15 a.m. U.S. Central Time, and it's going to be concise again today because once again there just hasn't been much movement in the foreign exchange compared to our assessment on Tuesday, which still means that the euro is soft. Secular weakness of the euro is the key. But it's all been very orderly on Wednesday and into this morning. And on the macro factors, as we know, previous data has been good, but geopolitical influences have been weak. The upset of House Majority Leader Cantor has led to a sense of maybe a bit more contention is back in the U.S. Congress moving forward. And, of course, the Middle East has been of concern given the recent problems, especially now in Iraq, that seem to leave things more unstable there than we've seen for some time. Now, the data that was troubling, or the fundamental influence that was troubling, was, of course, Wednesday's World Bank downgrading global growth to 2.8% from its 3.2% projection previous. But that's been offset to some degree by today's OECD Q1 quarterly accounts. While it did show some weakness in a good bit of the developing world, Australia, China, and Japan, representing the East, all saw pretty fair growth. And Germany was actually improved in Europe. And even places like Turkey and Mexico improved, along with the United Kingdom. So it showed overall steady G20 growth at 0.8, which is a pretty good figure considering it was equivalent to the fourth quarter of last year. Now, today we've seen weakish Australian employment and the Eurozone industrial production quite a bit better than projected as we head into quite important U.S. retail sales that are expected to be stronger after last month's weakness, and of course the typical weekly jobless claims. So moving over to what this means for the short-term view of the S&P 500 in the U.S., that's the 60-minute chart on the left, 30-minute on the right, and this has entered a critical sort of juncture after the recent short-term topping activity. And as we've highlighted before, that's the micro head and shoulders. Remember, this is all happening at the top of a more major long-term rally with recent intermediate-term strength pushing above 1900 to about 1955 at the highs. But that high was after this little activity last Friday. Left shoulder, head, right shoulder with the gap down on Tuesday after Monday's rebound, even after Monday's aggressive up channel down break at 1951, and the late rebound Monday stalled right there at 51, leaving that as the high of the right shoulder. And even though the market breaking down at 1946 on Tuesday morning could not follow through, neither did it get back above 1951. And it has to get above 51 to negate this overall topping pattern by getting above the high of the right shoulder, and also simultaneously on a confluence of factors, as we like to call it, would be knocking out the channel down break. But gapping down yesterday on the concerns we discussed were from the World Bank and geopolitical influences, we've got the market headed down. But what's important, this minor head and shoulders top only has an objective down at 1937, and that's very important because very often in these minor corrections and minor downside patterns within an overall bullish trend, the market never makes the projected downside objective. And as we saw, although it got below 1940 late yesterday, it did not quite close off the gap with a 1939 low back to Thursday's close at 1938.5. And we remind everyone that 38 was also a key upside objective out of the runaway gap the market exhibited coming in from Memorial Day weekend on that Tuesday. Now the question is, at approximately $1 higher on the day, whether it can push significantly back above 1946 to start to impugn the downward signal, and ultimately above 51 that would knock out all of the recent bearish tendencies and tend to send it higher. And that pretty much does it for the short-term view of the S&P. Going over to the intermediate term picture, what we have is a market that has stalled up near its topping line at 1957. That's up to about 62 next week on the weekly chart, but on the daily chart, the higher resistance is up into the 1970 to 75 area. That's also the weekly oscillator resistance. And in the meantime, the 9-day moving average has moved up to right about that 38 area. That's very important. So this has entered a very critical phase where it's either got to drop back below 37 to 38 to negate more support, or at some point we'll probably find an excuse to start heading up again.